The federal government just made it easier to get a mortgage. Sounds like good news, right? Lower the bar, let more people in, more people get homes. Everybody wins. Except here's the problem. Mortgage defaults are already rising. The FHA loan delinquencies just hit their highest point since 2021. And the answer from Washington? Let's make it easier to borrow. So I spent 27 years working for the federal government. And if there's one thing I learned in all that time, it's this. When the government says they're here to help, you better pay attention to the details. Because the help doesn't always land where you think it will. Stay with me here. Hi, I'm Jim Armstrong. I'm a realtor with Momentum Realty here in Jacksonville, Florida. If you're watching this, chances are you're behind on your mortgage or you can feel it coming. So stay with me. I'm going to walk you through some data and some policy first. But I'm going to get to you and your situation soon. I promise. Hang in there. And if you're an agent watching this because you're trying to help a client out, I'm going to get to you also. So when I see numbers like the ones that just came out, I pay attention, and you should too. Because it's not always about the numbers that they put right in front of you. Sometimes it's the numbers behind the numbers. We'll make that make sense in just a moment. The Mortgage Bankers Association released their first quarter for 2026 numbers on May 14th. The national mortgage delinquency rate increased to 4.44%. A year ago, that number was 4.04%. Now, 4.44% on the surface, that doesn't sound like the sky is falling, and it's not. I'm not going to tell you that it is. But here's the thing. If you're one of those homeowners inside that 4.44%, you don't care about what the national average is. You care about your situation. You care that you're behind on your payment and you don't know what comes next. Now, here's where the numbers get real. Let me break it down a little further. FHA loan delinquencies, that's the FHA ones, are up to 11.52%. Let that sink in. 11.52%. That's 6.5 times higher than the conventional loans. And it's the highest FHA delinquency rate since the second quarter of 2021. FHA loans are the ones designed to help people who don't have big down payments or perfect credit to get into a home. Those are the borrowers who are struggling the most right now. And foreclosures in general, over 118,000 properties have foreclosure filings in just the first 3 months of 2026. That's up 26% from the same period a year ago. Active foreclosure inventory nationally is about 273,000 loans. That's the highest that number has been since February of 2020. That is the backdrop, and that's where we're at right now. Keep that number in your head because what I'm about to tell you next is going to make you really think. But before we get there, if who I'm describing is you and you need help and you want to know what your options are, email me at jimarmstrong904@gmail.com or set up a time through my cal.com calendar and let's talk. And if you're an agent with a client in this situation, reach out as well the same way and we can discuss that. So the numbers are climbing. Delinquencies are up. FHA borrowers are getting hit the hardest. Foreclosure levels haven't seen this in 6 years. And what is Washington's response? Let's make it easier to borrow. On March 13th of this year, the president signed an executive order called Promoting Access to Mortgage Credit. That order tells the CFPB, the Consumer Financial Protection Bureau, to streamline mortgage rules for banks. Now, if you don't know what the CFPB is, it's the federal agency that writes and enforces rules for banks and lenders, and they have to follow them when they give you a mortgage. They're the watchdog on lending practices. The order also tells HUD to relax appraisal standards on FHA loans and push to reduce what they call regulatory burdens on lending. The stated goal is to make mortgages more accessible and more affordable. Pay attention to that part, more affordable. On top of that, both the House and the Senate have passed versions of the 21st Century Road to Housing Act. It hasn't been signed into law yet, but it's moving along. That legislation increases FHA loan limits, loosens appraisal licensing requirements, and adds flexibility across several FHA programs. And HUD has already been making administrative changes on their own. They've lowered the required history of broader income from 2 years down to 12 months. And they're allowing credit score flexibility down to 560. And they're calling all this compensating factors. Now, let me be clear. I believe the intentions are good, and the government wants to help people get in the homes. I understand that. But I spent 27 years in federal service. And the one thing I saw over and over again is when the government takes steps into the free market and starts adjusting the dials, the outcomes don't always match the intentions. Here's the part that bothers me. A free market works because both sides of the deal carry risk. The bank risks lending money to someone who may not pay it back. The borrower risks taking on a payment that they may not be able to afford. And because both sides carry risk, both sides make careful decisions. The bank checks your ability to pay. You check your ability to pay. That's how it's supposed to work. But when the federal government steps in and lowers the standards on one side and backdrops the bank on the other, that's where the math breaks. The bank is willing to make a loan it wouldn't have otherwise because the risk isn't really theirs. If the whole thing crashes, they know there's a good chance the government bails them out. We've seen that movie before. No, literally, they made a movie about this the last time it happened. And the borrower? Well, the borrower gets approved for a mortgage they may not have qualified for under stricter standards. They're told they can afford it. The government told them so. They sign papers, and then life happens. A job loss, medical bills, insurance going through the roof, property taxes jumping, and suddenly they can't make that payment. And here's the part that really gets me. When it goes sideways, the banks get bailed out. The borrower gets foreclosed on. The risk was never really shared equally. The borrower absorbs the real damage. That's not a free market. That's the government incentivizing banks to do something that they otherwise would not have been in their best business interest. And it's encouraging borrowers to take a risk that they might not fully understand. Now, if you're a homeowner watching this and you're already behind on your payments, stay with me. I haven't forgotten about you. What I just walked you through, though, is the backdrop, the bigger picture. But your situation is personal, and every situation is different. I'm going to talk directly to you in just a moment. Or if you've seen enough to make you concerned and you want to know more about your options, reach out. My email is jimarmstrong904@gmail.com or set up a call on my cal.com calendar. Down in the description is all the links. And if you're an agent trying to assist someone in this situation, reach out the same way. Now, if you're a first-time home buyer thinking about getting into the market, stay with me also. What I'm about to say might surprise you coming from a realtor. This is probably going to sound real strange coming from a real estate agent. My job is to help people buy and sell homes. That's how I earn a living. But I'm going to tell you something that might be hard for you to believe. If you barely qualify for a mortgage, it might not be the right time for you. I know, a realtor telling you not to buy a house, but that's how I see it. I'd rather see you in a stronger position when you go into that mortgage. Better position, not just barely qualifying because the government lowered the bar. Because when something unexpected happens, and something always does, you need room to absorb it. What I want is you to come to me ready and in a great position to enter that mortgage. We find the right home, you move in, you build your life there. And then when you're ready to move up, scaling up, or you're going to move on to a bigger and better opportunity, you come back to me and we sell that home through a traditional sale. You walk away with equity. Everybody's in a good spot. What I don't want is for you to come to me after you've already bought a home and say, Jim, I'm in trouble. I'm behind on my payments, and the home is not worth enough for me to sell it versus what I owe on it. And now we're having a completely different conversation. Now we're talking about short sales, and you're defaulting on your loan. That's not where I want you to end up, and I know it's not where you want to end up. So if you're a first-time home buyer and you're looking at these loosened standards thinking, great, now I can get in, just slow down, pump the brakes, do the math. Talk to a financial advisor. Make sure you're not just qualifying on paper, but you're actually ready. And your reality of that mortgage monthly payment is something that you can handle. You also got to consider the property taxes, insurances, plus the maintenance, because those numbers add up fast. Right here in Jacksonville, property tax collections are up 57% since 2020. In Florida homeowner insurance, the average premium hit almost $12,000 a year in 2024. That's 5 times the national average. These aren't small numbers. If you're a homeowner and you're already behind on your mortgage, or you can see it coming, here's what I want you to know. Every situation is different. I can't sit here in a video and tell you what to do because I don't know your situation. I don't know what your mortgage looks like. I don't know what your lender will or won't agree to. I'm not your attorney, and I'm not going to pretend to be one. But what I can tell you is the options exist. There are alternatives to foreclosure, things like forbearance, loan modifications, repayment plans, and short sales. These are real paths that real people use to get out of bad situations. Not every one of them fits every situation, but they exist. And the one I specialize in is short sales. That's where you sell the property with the lender's approval for less than what you owe on the loan. The lender takes a loss on the difference. You avoid foreclosure on your record, and the damage to your credit is typically a lot less than a completed foreclosure. That's my lane. That's my everyday. If you have an FHA loan specifically, you should know that the safety net has gotten tighter. There's a program called a partial claim. The way it works is if you fall behind, the government can take those missed payments, set them aside in a separate balance that you don't have to pay until you sell your house or pay off the mortgage. And your regular monthly payment picks back up right where it left off, like nothing happened. Now, that's a real lifeline, but they tighten the rules on it. You can only use it once every 2 years, and you have to make 3 consecutive on-time payments before you're even eligible. So, if you're already behind on an FHA loan, the path is harder than it used to be to get back on track. The bottom line is this: don't wait. Don't wait for the government to bail you out. Don't wait for your lender to call you. Don't wait for someone else to figure this all out for you. Take control of your situation. Either you're going to let them take your home into foreclosure, or you're going to make a decision and explore your options that let you come out on the other side in a better position. That's a conversation worth having, and it's one I have every day. So again, if you're a homeowner and you're behind on your mortgage, or you can see it coming, I want to talk to you. Not down below in the comments. You don't have to air this out in public. I have 2 ways you can reach me. You can email me directly at jimarmstrong904@gmail.com. That goes directly to me, and I'll respond personally. Or you can book the time on my calendar. The links are down below in the description. It's a free conversation, no pressure. I just want to understand your situation and help you figure out what your next step will be. If you're a real estate agent and you've got a client dealing with this, you can reach out as well, and we can discuss the different options and paths for you and your client. If you're an investor and you're looking at distressed properties as an acquisition path, reach out also. If you're a first-time home buyer and you really want some help in understanding what you're going to enter into in a real estate transaction, reach out. I can help you with that as well. I'm a realtor. I handle traditional sales for buyers and sellers both. I'm Jim Armstrong with Momentum Realty in Jacksonville, Florida. I'm not an attorney, I'm not a CPA, and I'm not a financial advisor. Everything I shared in this video is my opinion, based on publicly available data and my experience as a licensed realtor and 27 years of federal government service. If you need legal advice, talk to a qualified attorney. If you need financial advice, talk to a certified financial planner. But if you need someone who understands short sales and knows how to work with lenders when things go sideways, that's me. And if you appreciate transparency when you're in the market to buy or sell, reach out. I'll see you next time.